All right, let's get this show on the road. Thank you guys all first off for joining us for this webinar today, Friday. And I know everybody probably wants to get things going, but quiet market today for the most part, so it's a good time to learn about options. This is going to be how to protect your portfolio with options. A lot of people think that it's a losing sum game, but I'm going to show you different ways that you can use options to protect your portfolio. And this one's particularly going to be about the rate hike risk that we're going to be facing pretty soon. If you watched any of the Fed minutes and stuff like that came out on Wednesday, they said they're going to hold off now, but it is going to be coming down the road, and I'm going to show you different ways to protect against rising interest rates in your portfolio. Because if you have any bonds or notes in your portfolio, which most people have allocated 40 to 50% depending on your risk parameters, this is really going to be an eye-opener for you, I think. Anyway, so my name's Eric Wilkinson, and some of you may recognize me from online media. I've done stuff on CNBC, Fox Business, the Wall Street Journal, and I've commented on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now, and just so you know, I'm not here to tell you I'm going to make you rich. I'm not going to make you a millionaire, but I'm here to help you take control of your finances, manage your portfolio, and most importantly, manage your own risk. Like I've said, I've traded everything in my 20 years, from stocks, bonds, financial futures, commodity futures, currencies, and options on all of these products. So I've been doing it for quite a while. I'm not going to tell you that I know everything there is to know about it. I still learn every day. So, but these are some of the rules that I've come up with throughout my trading career that I've found work out quite nicely, and I want you to, educate yourself and maybe implement some strategies into your own account. Not necessarily the ones that I come up with, but take what I teach you and implement those types of things into your own portfolios. And having said that, I do have a disclaimer I've got to go over. Basically, this is saying that Pro Trader Strategies is an educational company. We're not here to swim for you. We're here to teach you guys how to swim. Anything that I talk about is not necessarily, just take this strategy and implement it into your own portfolio today, because it may not fit your risk parameters. It may not be the right strategy for your portfolio. If you guys are long a particular stock and I'm going against that stock, it's not necessarily the right strategy for your portfolio. So take what I teach you and implement it into your strategy of your own portfolio. So the bottom line is you have to do your own homework, And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. If you watched any of these, I'm sure you've seen that disclaimer before. So like I said, this is using options to protect your bond portfolio. And as interest rates go up, bond prices I should have in there, I didn't really realize that, but the price of bonds goes down. So they are inversely correlated. And this next slide is going to show you how that works. So if you started out with a $250,000 portfolio in bonds, which would be a very large portfolio, and interest rates go up by just 1%, you can see you've lost $50,000 in your portfolio already. Now, on a 30-year bond, of course, you will get par value back after 30 years. The average person only holds their bonds or their notes for about 7 years. So in that course of time, if you were to buy at par value and then sold it later, you might only be getting 90% of what you paid for it. And there's no way to really catch up, to chase the interest rate, if you will, to get a higher coupon payment, because the loss on that selling of that bond will never be made up for like 7 years on the increase in interest rates that you would be receiving. This is what's going to happen as soon as the Fed starts increasing rates. People are going to be in bonds and are going to see this really go down in value. And these guys are major fund managers. They do the mutual funds, and Vanguard at the top right is a huge proponent of mutual funds. And what these guys are going to have to do is they're going to be chasing yield. So they're going to be doing exactly what I just talked about. They're going to be buying high and selling low, chasing yield. And that's going to really decrease the value of these mutual fund portfolios. Of course, this guy down here, no, he's not really a fund manager, but thought it was funny all these guys were flashing all their money. And that has to do with the amount of money that, the thought process there was the amount of money that these guys are charging in fees. And if you guys just take control of your own finances, the learning curve will be much less painful than the amount of money that you guys pay these guys. So in this tutorial or this webinar, I'm going to be talking about the wrong way to trade options and the way that I trade options. Notice I didn't say that it's the right way to trade options, just that it is the way that I trade options. The wrong way to trade options is buying options with high IV. Now, what is IV? That's implied volatility. And as implied volatility increases, when you're buying options, that's when you would see the increase in the premium. But if you buy those options with high IV and that IV comes down, then you're going to see loss even if you're directionally right, because the premiums will compress, and even if you're directionally right, you could see that you're losing money. Or buying options with high theta. If you buy an option, you know, a long-term option or a weekly option or any of those, they have theta, and that's time decay. So as you get closer to expiration, that theta really starts picking up. And I've got a chart a little bit later I'm going to show you about theta decay. So if you buy options with high theta and all of a sudden you are fighting against it, again, you could be directionally right, but if the market is just a slow trickle up, that high implied volatility is going to come down and the theta is going to come down, and even if you're directionally right, you can still lose money. And you guys will see that I am not a big fan of buying options if you ever watch any of these. Or selling options with low IV. Right now it's really hard to find good options to sell because we are in a low IV or a low implied volatility environment. As the market just continually creeps higher, there's no real fear to the downside. You really see implied volatility spike around, say, earnings or another type of binary event. But right now, it's steady as she goes. So we're really in a low IV environment. But I've got some strategies in later webinars that I'll show you that you can take advantage of that too. Or selling options with low theta. Again, if you're selling an option way out in time, you're going to really take a lot of risk by selling that way out in time, because you're just not going to see theta decay. You could be directionally right, but you're just not going to see anything happen with that option. And the way that I trade options, I like to receive a credit. The fact of the matter is if you're buying options, you're just fighting against so many different things. It's kind of like it's trying to stop a wave from happening. It's going to keep going. So I like to take a credit and watch that theta decay and watch that volatility contract and take advantage of that. So I like to sell in high implied volatility environments, and I've got a little bit of a ratio that I like to do. I take that IV rank that you guys can get on your trading platforms, and I create an IV rank. And what that is I take the high point of the IV minus the low point of the IV and divide that by where the current IV is by the low IV. So I subtract the high IV from the low IV, and I subtract the current IV from the low IV, and I create a ratio there. It'll give you a percentage point. So if it's above 50, then that is a go sign for selling IID. And I like to sell for theta decay. So I try and put it in at about 45 to 30 days is the sweet spot, if you will, for taking advantage of theta decay. And like I said, I've got a chart that'll show that really nicely here coming up soon. And on the rare occasion, I buy these option contracts, but I try and look to finance it by selling some type of option and create at least a credit or just no loss, debit, no debit. So, so selling a call. First one's going to be on selling a call, and this is bearish, but this is also going to have a little bit more risk involved. And when we're selling the call, you have more risk, but you do have higher reward. This will not work in an IRA, just so you know. If you guys are trading in an IRA, you have to do a call spread, which I'll be going over a little bit later. So this is the chart the reason why this is why I like to sell calls, because you get cash right now. I don't have to wait for it. You get cash now, and then once you start seeing the theta or the vega contract and see that premium come in a little bit or come tighter, closer to zero, if you will, then that's when I like to do those types of strategies. And short duration. I like to use the shorter duration. I don't like to use the leaps when I'm selling calls. There's just not enough theta decay involved in those. Sometimes I will do them on the weeklies, but very, very short term. I'm going to be talking about using around a 45-day to 30-day window. And as you can see in this chart here, with 28 days to go in this chart right here, with 28 days, if you start at like 35, I usually kind of look around 45 to 30 on the far inside, because you get this much theta decay. That's a huge drop. And think about it, if you use the 90 days, it takes a long time for that theta to start decaying. The top is for the calls, puts decay a little bit faster. Generally because puts have a higher premium value in them. Fear in options is prevalent, so you'll almost always see higher premiums in puts, and therefore you'll see a higher theta decay. But as you can see in this window here, you get a dramatic downstroke in theta decay. So look to put your strategies on around 45 days. That's about where I like to put it, 45 days to 30 days. Inside of there sometimes, depending on what volatility is doing. And picking the correct strike. Now, how do you pick the correct strike, right? I usually choose out of the money strikes. And by picking out of the money strikes, you have a tendency to be, let me try and get rid of this little, I don't know why that drawing's showing up. There we go. So right here, so this is the delta. So you've probably heard of delta, theta. Theta is the time decay, and vega is the volatility ranking here. And delta is just basically, if you wanted a perfect hedge on something, you would need this many options contracts to hedge. The option for one standard deviation is where I like to go out, because that gives you one of your best probabilities with the amount of money you're going to return. So if you get like a 35, 36 delta, that gives you about a 66% probability of staying out of the money. So that's just a little options hack for you. Just like when you're in the money, these are probabilities of staying in the money for the most part, the inverse of those. Subtracted by 100 for the most part. And position management. Now, especially with the calls, this is going to be very, very important. You're going to have to watch the calls, especially if you're just naked these calls. You're going to be naked in the sense that there's no upside protection for you when you're selling a call. You are hedging a bond portfolio, so you're assuming that you have bonds in there. So if you have 100,000 in bonds, you would be hedging that appropriately. So take how many bonds you have and look to hedge that appropriately. That being said, in an account, it's not going to show up as, say, for instance, a covered call on a stock. If you own stock outright, you can hedge that with calls, and it's called a covered call. I can't really call this a covered call because it's very, the options that are out there aren't necessarily going to correlate to the particular bond that you have or the muni that you have in your overall portfolio. So in a trading account with this type of portfolio management, you're going to have to really keep an eye on it, because you would have to deliver the underlying if it gets called. So portfolio management, that's going to be key here, and you're going to have to know when to get out also. So take what your loss is, put the stop loss in there, and just get out of it if it starts going against you. Now, this is also portfolio management. So for instance, now I took this chart yesterday, and this is why I can't really give a recommendations, because yesterday a great place to sell this, and it actually held so far today, was bonds have retraced right here to the 52 handle and bumped up against it a couple of times. That's the resistance area. Yesterday it looked like we were selling off quite nicely. But that's why I picked this strike location also on the 52s. In the last slide, if you remember, that was on this 52 strike because it was just above this area. So I took a resistance line. It was one standard deviation. That's where I would generally enter a short call type situation. And this is what you would analyze it to be. So if I were to sell one of the bonds at the 52 strike, I would receive 1.13. Well, what is that? The bonds are a little bit funny. 1 point in the bonds is $1,000, and 13 is the fraction of 1 point. So you need to multiply 13 by $15.63, which is the tick value in the bonds for the options, and that would give you $1,203 or something. Now, if you're going to be trading bond options, which is something that I've traded a lot of, but you notice your buying power effect is huge. That's because this is traded by the big boys for the most part. This underlying is $100,000 worth of bonds. So the buying power effect in the bonds will, you have to have a lot of money in your portfolio to be trading the bonds, is what I'm saying. You want to allocate only about about a maximum of 3% of your overall portfolio to any particular strategy. So in that case, 1%, you would have to have almost about $100,000 in your portfolio to allocate something like this. And this goes on. This is the bond. This is really just to show you how liquid bonds are. You can see the open interest right here. There's tons of open interest. That's another key thing to any options, whether you're looking at trading. Tesla is another good example of highly liquid. Something that's not very liquid would be like Deere. And when you see the bid-ask price is 2 cents wide, and you could probably sell it at 12 cents or buy it at 12 cents, that is highly liquid. There's always somebody in there playing in this market, so you can get in and get out if it really hits the fan, if you will. So look for high open interest, high volume. These are the big boys. They're trading thousands of contracts at a crack, but I'll show you some things that won't take as much of your overall portfolio, the buying power effect. But this is just to show you that there's huge volume there. This is also a little bit further, another example of the bonds with high open interest, even in the weeklies. And this is the notes. So again, in the notes, I drew a support resistance level here. That's really starting to break down as a support resistance level, but as you can tell, it's held. It's starting to trade around that on both sides. So the bulls and the bears are really fighting it out here. But that's why I picked this strike of the 26.5, was because of that support resistance level, to sell the calls at 26.5. And if you're, like I said, in an IRA, we'll go over some call spreads and why I would choose those. That's basically a one standard deviation away from where I was trading yesterday. And this is a options chain of the notes. As you can see, you get way out on these option chains. This is where I was trading yesterday. That's at the money. And when you're really far away, you can still see that there is still open interest way out. So even if the market moves in your favor or out of your favor, you can easily get out of some of these kind of contracts. So look for that. And this is TLTs. So most of you that are trading with smaller contract or smaller portfolio values, TLT is going to be a nice substitute for that. This is the 20-plus year Barclays iShares. So it is an ETF on a portfolio of different types of bonds and notes with over 20 years duration. So if you have a lot of ETFs or mutual funds, this would be something that you could use to hedge that. And I drew this as a support resistance line, but what was interesting about this is this line here, it kind of breaks through. So this wouldn't normally be my exact support resistance line, but it came to a fib 50% level. So that makes that pretty strong as a support resistance level on that. And as you can see with the TLT, again, you have a lot of open interest, a lot of contracts being traded. They trade like 8 million contracts in the on the ETF a day, so that's a highly liquid contract. These aren't going to be, this is where most of your retail traders are going to be. So these are where you can get in and out of one lots pretty easy. So, and as you can tell, the bid ask is about 5 cents wide. It's slightly wider than the bonds, but you could still get filled at a mid price of say 193 here, or say 146 or 147. There's always people in here and are looking to give up a little bit of edge if they see it. So these are another example of highly liquid contracts where you can, as a retail trader, really really get involved. So, and as you can see, even further out, you have with TLT a lot of open interest, 221 days to go. So this is a highly liquid contract. So if you wanted to do different types of calendars or any of those types of things, you can really set up with any of these from the short term to the long term. So it's a very nice substitute if you didn't want to have to lay out a lot of money like in the bonds. And then TBT is another ETF, and this is an inverse to the TLT. It's another ETF, and this is an ultra short. So this, if the bond prices going down because interest rates are going up, kind of confuses you a little bit on which direction you want to go. If interest rates are going up, TBT is going to go up as well. That is, TBT is directly correlated to the interest rate movement. TLT is directly correlated to the price of the bonds. And as you can see here with TBT, a lot of open interest again on the monthlies, the weeklies, not a lot in this example here, but in these weeklies there is a lot of open interest there. And then TBT, trying to show you the weeklies here, so you can tell there's 8 days ago there's still a lot of trading going on. The bid-ask price is still within around 5 cents, 6 cents. So that shows you that there's liquidity in there, and you can easily get filled within the mid price there. So this was relatively early on in the day when I took these snapshots, and the open interest is good, and so is the the trading volume on a daily basis. So on TBTs, you would likely want to, if you really only like to buy calls, this would be a good one. You could buy calls, and as you can tell, as interest rates go up, you can capture that on the upside. But if you're going to trade TBTs and you like to collect premium, you have to do the puts because you're trying to capture upside there, or you're slightly bullish. And here's a little bit of a trade hack for you. Short call guidelines. This goes for any naked option for that matter. So even if you're trading calls or puts on stocks, you can kind of use this. Naked option, this is what I generally will use. So the amount of premium you collect, if it decays 10% in a day, I'm not going to take much more risk than that. You know, I'm going to look to cover that. I'm going to take my money and run on these things because as time goes on, you're increasing your risk. So if after 7 days I've got almost 40%, or after 15 days I've got 50%, or if I have 3 days into this trade and I've got 50%, I'm covering it. So anything less, any days less than, and I've got this percent of my max profit on selling that call. Say I sold a call for $1 and in 7 days it's trading for 50 cents. I'm covering that trade. I'm taking my money and running. I'm not proud. I'm not gonna tell you I'm gonna write it to the bitter end. I'm not going to, because the fact of the matter is I'm taking on too much risk for the amount of money going on. 7 days into the trade and I still got 30 days of risk. It doesn't make sense to me for 50 cents. All right. So this is a little trade hack for you, and you guys don't really have to worry about writing all this down. You can get this sent to you in an email afterwards. We're recording it. So, but just keep that in mind. 10% profit in 1 day, that's a win. 2 days, 20%, that's even better. You know, inside of 7 days, I got 50%. That trade, I'm forgetting about it. It's gone. So now we're going to go on to call spreads. Call spreads you have to use in an IRA. You have to have defined risk in an IRA. So these are going to be things that that you can use. Now, you are going to collect less premium when you're using a call spread. You're going to have less risk, though. You can widen up those call spreads out as far as you want, though. So you can sell at 1 standard deviation and then take it six, 7 strikes higher to get out of that call spread. Or on a put spread, you can go 6, 7 puts lower and pay pennies for your protection. So keep that in mind. The examples I'm showing you are going to be just 1 strike wide for the most part. And again, the essentials to success here are going to be choosing your right strike price. And choosing the right strike is still going to be, when you're doing a call spread, I have it set up here. You can see it as a single spread or a single strike, because I want to find that delta that for my trade hack right around 35, 36, and that gives me about a 66% probability of being in the money, or out of the money, I should say, being out of the money because I'm selling out of the money calls. And then, like I said, so you could buy protection way down here for a lot less. So you'd still be collecting the dollar there, so to speak. And again, it's going to be choosing the right duration. Again, right inside that 45 to 30, I'm putting these trades on, and I'm looking to cover them probably right around in here, 14 to 7 days to go. You get inside of this, yeah, you're getting a lot of theta decay, but those would be where I'm trading the weeklies. I just don't want to take that risk of big money pushing that stock around going into the last couple of days. You'll see that a lot where big money hedge funds and stuff like that will try and pin the price, so to speak. So I'm trying to I call this getting in the zone. This is the cash money zone right here. And like I said, choosing the right environment. High vega, up against support or resistance, and the right timing. That theta, I want that theta decay to happen. And the right underlying, that has to do with liquidity. That is the key to any successful trading. Liquidity. If you have a 35-cent wide market in these options contracts, don't trade it. I don't care if you love the stock or not. I don't preface this, I don't love or hate any stock. I look at the technicals, I look at the liquidity, I look at the vega, I look at the theta, and I make a decision on what I'm going to do with that trade. I don't care if it's Tesla and they have the best product out there. I don't care if they came out, I mean, I just don't care about different stocks. They got to have liquidity. I do implement, I shouldn't say I don't care about any stocks. I do like the fact that Tesla did come up with a couple of new products that they're going to be coming out with. So in something like that, I might put on like selling puts. But it's going to have all my requirements. It's going to have that duration of being in 45 to 35 days before I put in that contract, and it's going to have some theta decay. So I need to see that, and before I'm going to enter into any type of trade. All right. And always know your exit strategy before entering the trade. Know when you're going to get out, just like that trade hack that I showed you of taking percentage of profit. Know that you're going to get out at a certain level and do it. Stick with your rules. And that's the key to any trading. Know when you're going to get out. Know when you're going to say uncle, or take your money and run. And like I said, with the call spread, you do have lower risk, but you do have higher pop. And pop is probability of profit. And probability of profit, you've got to figure out your max loss. So you're going to take your strike price of your long call and subtract that from your strike price of your short call, minus the net premium received, and plus your commissions paid is basically how you figure out your max loss. And your break even is going to be your short call plus your net premium received. So wherever that's trading. So if you're trading a 50 strike and you got $1 from selling that call spread, then when the underlying is trading at 51, that would be your break even for the most part. If I have a defined risk strategy, I usually, if I put it on, I'm going to either take a percent of my profit or take the max loss. That's usually how I work. I put it in as a strategy, and I believe in it. I'm not going to play around with it. And this again is our support resistance line for the bonds. So on the strategy for the bonds, I stuck with the 52 strike. Remember, this was yesterday, so today would be a better time. I'm also a contrarian, so as bonds would rally, that's when I would be looking to put on a call spread as they rallied and hit up against that 52 support resistance line that I just showed you. Today, this is a green bar going up right next to that bar, and it popped right up against this support resistance line. So today I would probably be better off being able to do the 53 strike and get that same credit that you saw here. I probably could get that same credit today selling the 53 call and buying the 54 call. Again, here as an example for the notes, I use that support resistance line that really has proven further out in time as well. So that's a pretty major one in the past, and it's balancing. And you'll see that happen on support resistance lines after it's been challenged a few times here and there and showed support or resistance. It's going to start bouncing in and around that a few times before it really picks a direction for the most part. And again, here I did the 62.5 calls and bought the 11 calls. One that this would not meet my necessarily my parameters. When I'm doing a call spread or a put spread, I like to collect 1/3 the width of the spread. So this is only 50 cents, and I'm only collecting 11 cents. Whereas, let's see, in this example of TLT, you can see 30-cent credit for a dollar-wide call spread. Another trade hack for you. Collect 1/3 the width of the strike, if at all possible. An 11-cent credit here, I'm probably not going to take that trade on. It's not going to. I'm not going to get enough decay in that. So TLT, like I said, this was the Fibonacci retracement that I found, and for that trade, I would do the TLT, selling the 119s for protection, buying the 120s. And as you can see right here, this is one standard deviation move. So I'm well inside of that, so that's nice. And I would collect 30 cents. So on my trade hack, 30 cents. I'm looking to collect about 25 to 50% of that credit received, and most likely, if I got 25% of that credit decay, you know, that's when I would look to cover that kind of trade. Taking profit on 25 to 50% on call spreads. Usually, call spreads I like to take 50%. On straddles, strangles, which I'm not going to talk about in this webinar, I'm looking to take only about 25% for sure. And this is the TBT, support resistance line. It is kind of hacked off here. This support resistance line, again, I didn't want to put on the whole chart so you could see it easier. So this is just a continuation of that. And with TB having that as my support resistance area, I would be selling the puts, the put spread. So I'd be selling the 50 puts and buying the 49 puts for protection. So in that TBT example, so I would be selling the 50 puts. So right there, and buying the 49 puts, which is right around in here. So I'm expecting interest rates to rise, and like I said, if interest rates rise, TBT is going to rise. This 49 level showed pretty good support throughout time. You can see over here it's around 49 area, so that's where I put my my stop loss, if you will, because if it goes through that 49 severely, it could easily trade down to here. So I put it pretty tight because if it goes below 49, it could easily trade down here and test this area. But again, on that one strike call spread, I'm looking to take 25 to 50% of my max profit and run, or take that full loss, because over time I got plenty of time in that trade to have it work back out. So yes, I probably will get tested on it. Most likely you will get tested on many of your strategies, but stick with the course and stick with your rules. So that's about it for the bear call spreads and the call spreads. I'm going to open it up to oh, I guess I spelled duration wrong somewhere. Sorry, I just looked over at the. Sorry, Alan. No, I didn't notice I spelled it wrong. I'll have to check that out. So I'm going to open it up. Do you guys have any questions about this? I'll answer some questions for a little bit and go into the questions box and let me know if you guys have any questions about some of those strategies. I'll try and work it out. Leonard, which charting program do I use? I like to use TD Ameritrade. I just think that they have a lot of the charting things that I like to use. I didn't really gunk it up. Some of my charts get really busy, so I try to keep it pretty clean here. Would you consider doing a trade on TLT? I guess puts. Oh, sorry, it's scrolling off on me. Hold on 1 second. Let me fix this up for you. All right. Would you consider doing a trade on TLT? I guess puts, since you were thinking interest rates would increase. Well, if interest rates are going to increase, I would not do puts. I would be selling calls in those. If you are stuck to buying options, then yeah, you would buy puts. But I like to sell options and collect the premium, so I would be selling calls on that. Does a wide bid-ask spread usually indicate a higher probability of volatility? Well, a higher bid-ask price could, during highly volatile markets, you will see a bid-ask price widen up. Yes, you're correct. But usually a high bid-ask spread is indicating that there's not a lot of players in there. There's not a lot of participants in that market. So if you're in that market, especially during low volatile markets, then when it gets volatile, it's going to get even wider. They're not going to take any risk on that. So that's why I like to choose something that has a lot of participants, a lot of open interest, because those people will be in there even when it's volatile, trading in and out. TD Ameritrade, yes, it is Thinkorswim, James, to answer your other question, and Leonard. Would you consider selling option spreads versus buying an option? At which volatile percentage, 20. I wouldn't buy. TW, I think I'm answering your question. I wouldn't be buying. I look at implied volatility as a rank. So, like I said, I take that high. So, for instance, this is historical volatility, and so what I would do is take the high and the low, and I have the historical here. I have the implied underneath it, but I cut it off. But I would take the high minus the low, which it looks like it goes a little bit lower here. The high minus the low, let's just say for an example, high minus the low on the top, so 4 minus 2.5, and then I would take this 33 minus the 25 on the bottom side of the equation, and then I would divide those two. So if it's above 50% is when I'm going to be selling my options. Is that what you were asking for, TW? Well, that is TW. When would I consider row? We haven't had to worry about row recently, right? I mean, with no interest rate movement. So in the future, we've been talking about doing a webinar on row. That gets a little difficult for some people to understand. It kind of goes down the lines with talking about gamma. But yes, I will be doing a future webinar on row. And I haven't really considered row lately just because we haven't had to worry about it, right, with interest rates. But that's going to be becoming a very real reality soon. Fred, what option software can a retail trader use to backtest strategies over historical price action? Rely on getting a broker platform, purchase a specialized subscription. I think that NinjaTrader is an affiliate of ours also, and I think they're real good about doing that. So if you wanted to talk to them, I think that they do something. We also TT is more along the lines of for a retail trader or a professional trader, trading technologies, and they have pretty easy software to work, and you can program your own stuff. Does that answer your question, Fred? George, yes, this is being recorded, so you will be able to get this email to you. Jerry W., what was the question? I'm not really sure what question I was talking about at that time. TW, yes, I look at historical volatility, but when I come up with that implied volatility rank, I'm using just the implied volatility. So I just look at this for the historical, but when I'm doing that ratio, like I said, I'm going to, just as pretend this is implied volatility, I would take the high minus the low, what the current is on the minus that, and divide them by each other to come up with a percent of where it is trading. Implied volatility is basically where implied volatility is against its implied volatility. So it's hard to just look at implied volatility for a particular product because, some products don't have very much volatility. So when you're just looking at implied volatility, it doesn't show what its implied volatility is against itself unless you come up with that equation. Alan, yes. Further from the strike, out of the money is higher probability of expiring worthless. Yes, but I try and do it about one standard deviation away because you get really far away. You pay commissions and you're only getting 8 cents for your strike, then it really isn't really making a whole lot of sense to do that. And the Greek I use is I take the delta, subtract it from 100, and that is your probability of being out of the money. So that's why I try and choose the 35 delta, subtract that from 100, you get about 65, right? So 65 is one standard deviation, as you can see, right? 66 is about one standard deviation, 66, 67. Yeah, delta minus 100. It's just a trade hack. So just look, the easiest thing to do is just kind of look for that. What does Ninja Trader cost per month? I'm not quite sure. And yeah, gamma is the change in delta. And yes, it does. It is more important near expiration, or expiry. Gamma is kind of like implied volatility rank. It's a rating of itself. It's the change in delta. All right, is there any more questions that I can answer? I don't see any new ones coming up. I think I answered everybody. If I didn't, let me know. All right, like I said, did I see somebody else pop up one? With respect to puts directly versus. I don't like buying in the money puts or any of that really necessarily. I don't like buying options for the most part. I usually am playing around with out of the money stuff and selling them. So. All right, that's about all we got for you today, guys. Appreciate your time, and just want to thank you guys. You know, you can I do a daily market commentary also on ProTraderStrategies.com that you can check out. I didn't get one out today. I was having a bit of a computer problem, but check those out. They're almost out every day anyway. And later webinars, I'm going to be drilling on different options components and how to trade different types of strategies and when and where they're going to be appropriate. So check it out. You can go on. This is the link right below here, and it's also going to be in the box there for ProTraderStrategies.com that you can sign up and get later webinars and check out the offers, because I'm going to be putting out some other things in there too. And if you have any questions, you can call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. So I hope to see you guys soon in different types of webinars that we'll be drilling down on this, and I appreciate all your questions. They're all good questions. And that's all I got. If you can't take that, take it easy.